Mr. Chairman and members of the committee, thank you for the opportunity to testify today. Thank you as well for your tenacity on the issue and your longevity. I'm sure you're all quite hungry after a long day of this. My name is Doug Heller. As Bob said, I'm here at Bob's request, but I also represent Consumer Federation of America, a national nonpartisan consumer organization. For the past several years, I've conducted research and represented the Federation on auto insurance issues and around the state. And so my testimony is informed by the research I've done for the Federation, and I speak on behalf of the Federation as well as on my own behalf. I've been asked to provide my views on the Omnibus Premium Reduction Act, and I should note at the outset that I am not an attorney or an expert in civil litigation, which seems to be the primary target of the language in this bill. And I'm happy to talk about my experience with the impact, or more relevant, I think, the lack of impact of tort law changes on consumer insurance premiums. But the focus of my testimony is what I believe this legislation would need to include to really be a premium reduction act, which I think is the goal of everybody on the committee and in this room. Auto insurance is unique because it's really the only product that government requires us to buy. New Hampshire is the only state that doesn't require consumers to purchase auto insurance, but here in Louisiana and in 48 other states, it is mandated. And so given that the state regulates the behavior of Louisiana drivers by mandating that they purchase auto insurance, I believe there's a special obligation to make sure that the rates residents are charged are fair and affordable. And it's troubling to me that a Premium Reduction Act, let alone an Omnibus Premium Reduction Act, is before you that requires no reforms of the insurance companies that charge these high premiums, as though insurance company pricing and practices are just incidental to the cost of coverage. The research that I've conducted over the years, including a major study of regulatory systems across the nation that Consumer Federation published this February, shows that strong Department of Insurance oversight of insurance company rates and pricing practices results in better outcomes for consumers than we see in states where there is less transparency and weaker oversight. Louisiana, by a host of measures, falls into that latter camp of generally deferring to insurance companies at the expense of consumer protections, and I don't see anything in this bill that addresses that core problem. In order to illustrate what an Omnibus Premium Reduction Act might include, I'd like to start by sharing with you some research that I've conducted about premiums here in the state that will shed some light on premium reduction tools that you could adopt in order to create savings for millions of safe driving residents in the short term, and I think for all drivers in the long run. The research looks at the way that current law and regulatory practice has allowed insurance companies to overcharge low and moderate income good drivers in particular. And these are the folks who are shouldering the heaviest burden when it comes to the challenge of complying with the state's insurance mandate. And they are also the most likely to fall into the ranks of the uninsured or suffer the economic consequences of not being able to drive or, as was discussed earlier, not being able to run their business. The data I will share from you right now comes from a national name brand auto insurer who does sell in the state and is one of the largest providers of insurance in the state. What you need to know about the data I'm going to share with you in a moment is that they are premium quotes, actual premium quotes that I received online from one of the major companies. I'll be providing it for a 35-year-old driver who lives here in Baton Rouge, zip code 70802, always at the same address. Drives a 2013 Ford Fusion, 10,000 miles a year, and has a perfect driving record. This is critical. Every single premium quote I'm going to give you for now is for a driver who has never caused an accident, never gotten a ticket, never filed a claim. And the quotes that I received that I'm going to share with you are for basic liability only policy, that $15,000, $30,000 minimum required. It's the cheapest policy anyone can buy to comply with the state mandate. But just know in advance that all of these quotes, the same kind of structure and problems that I'm going to show in this data, they would apply whether you bought just that minimum liability or more expansive, or if you needed to buy comp and collision because you have a note on your car, the same problems apply. So we'll begin with the first driver that I tested. It was a man, I'll call him for the moment if you don't mind, Robert, who is an investment banker. He has a Master's of Business Administration degree, and right now he currently has a $100,000 auto liability policy. So he has a full, robust insurance policy on his car, and he's out in the market shopping for another one, for another policy. When he gets a quote back, and again, I'm just using the minimum liability for comparison purposes, the basic minimum liability only policy for Robert, he's being offered a price of $721 per year, quoted. Now, I went back and I changed Robert's name to Roberta. Now is a female driver, so she, still an investment banker with an MBA degree, still buys that full rich coverage, still lives at the same address, same car, same perfect driving record. That same company quoted her for the same exact policy, $847 per year. That's $126 more because of her gender. Now, let's rewind again, and let's say that Roberta doesn't work on the top floor with the corner office as an investment banker, but down in the retail section of the bank, she's a bank teller. And that company, same MBA, same everything else, that company gave her a 5% surcharge because her collar isn't quite as nice as when she was an investment banker. She's now paying $887 a year. Another change, let's say Roberta doesn't have that MBA degree. She just has a high school diploma. And of course, that's like a significant majority of Louisiana residents. She hasn't changed her driving record or how many miles she drives each year or how much it costs to repair her car. But her education level causes her premium to go up over $1,000. Now it's $1,022 a year, $135 more per year because she only has a high school diploma and not a master's degree. Now, let's say what happens when downsizing at the bank and Roberta loses her job. Roberta's now uninsured, and when she goes back to this company to get a quote and says that I'm actually not uninsured, unemployed. She says I'm unemployed when they ask her what her job title is. They say, oh, okay, well, that's a 15% penalty for being unemployed. Her new premium is $1,178 per year. Remember, originally for Robert, it was $721. Now, I made one more series of changes that I want to talk with you about because our unemployed Roberta, now she's shopping for insurance, but now let's get to the real Roberta. She didn't have a rich, robust $100,000 liability policy in the past, but she was complying with the law. She had that basic minimum liability, and that's what she tells the insurance company when she gets a quote. Same car, same address, same perfect driving record all her life. But she didn't buy the rich policy in the past. She only bought a $15,30 policy. She comes back for a basic liability quote. Her premium shoots up another $450, and she's being charged for the same exact policy, $1,631 a year, just because she didn't buy as rich a policy in the past, even though she's getting a quote for the same coverage as Robert did. So the last tweak to hers, Roberta puts her car in the garage, says, I'm not driving for a while because I can't afford all this stuff, hangs the keys up, and takes a few months off. But over time, she realizes she's not going to get a new job if she can't get out to all those interviews. So a few months later, she comes back to the insurance company, and they ask her, who's your current insurance carrier, and how much coverage do you have? And she says, well, I'm not insured. And they have a pull-down menu on their website. She actually selects, I haven't needed insurance. So she tells them, I haven't been driving uninsured. I haven't been doing anything illegal. I haven't needed insurance while my car was parked. The premium quote for her now is $2,327 a year for the same exact auto insurance basic liability policy, despite her perfect record. So Robert, the investment banker, he could buy 3 of those liability policies and still have money left over compared with what Roberta is being charged for the same exact product.
A couple questions for you
sure.
on that.
Of course.
Senator Gaddy.
I hear a lot slower than you're talking,
I'm
so
sorry.
I apologize. I just want to make sure I got that right. So you have the investment banker at $100,000 policy. Is that what you were comparing the Roberta with 15?
He had a $100,000 policy. It's what I'm getting at is the insurance companies, they don't just look at what you're buying now. They look at what you used to buy because that tells them, oh, you're a customer we might want. So they're all buying the same product. They're all going out and getting a quote for the same minimum liability policy. But in the investment banker's past, he used to purchase a real rich policy, a $100,000 policy, which is a proxy for his income, and that's what the insurance companies see. That's what concerns me, is all these things are different ways the insurance companies assess whether or not we want to serve that good driver.
All right, so back to the last hypothetical you gave.
Yes.
It was Roberta.
Yes.
She put her car in the garage for whatever reason.
She didn't drive for 3
So
months.
she had to honestly put in her application, I haven't had insurance. I haven't needed insurance because my car hasn't moved.
That's correct.
Now, what was her premium?
$2,327 per year.
And that's some of the biggest complaints I get at my Senate office is I lost my job, I parked my car, and honestly, some even say I drove it without insurance for a while because I had to go to the interviews. And when they go to re-up, they have DMV penalties they have to pay that are substantial, and then their insurance rates are very high. And now, once again, just for the people that are listening, because people are listening to this all over the state, sure. All of the hypotheticals you gave were for a clean driving record?
All of these examples were for somebody who has never caused an accident, never gotten a ticket, never filed a claim in their life.
Okay, thank you.
I will tell you, I will move on to tell you something. I did go back and test Robert, the investment banker, one more time. But this time, I said, well, Robert, the investment banker, what if he caused an accident? What if he had a ticket? So I looked at a quote for Robert for that basic liability insurance with an accident on his record and a speeding conviction. And his rates did go up from that $721, but he was still charged $500 less than Roberta was charged at the end of the day. So that means that the insurance company says, Robert, the investment banker who used to buy a rich policy, the fact that you have an accident on a speeding ticket on your record is not nearly as bad as Roberta because she put her car in the garage for a couple of months and she doesn't have a good job or a big income. Now, I want to add, I didn't test a couple of things that are, I think, quite important. I didn't test marital status for this example, but we know that insurance companies charge single people, divorced people more. In fact, I did do research here in Louisiana, and I found several companies that will charge a surcharge of between 4% and 15%, according to my research, for people who declare themselves widows rather than married. That means that if your husband or wife dies, when you go to renew your insurance policy, even if all you ever had was one car, you're going to see as much as a 15% penalty, a widow's penalty under this law. Now, one company charged a woman in New Orleans $172 more for her basic liability insurance after she told them that her husband had passed away. I also didn't test for home ownership, but a number of insurance companies will charge a good driver, more if they rent their home rather than own the home. And that's before combining coverages. I'm not even talking about the discount they're going to give you for having multiple policies. Just for being a renter, you pay a penalty on your driver's insurance. And then lastly, I did not talk about credit score. And this is a significant issue, and I know Senator Luneau has brought this issue before various committees. Most companies in Louisiana punish good drivers with higher rates if their credit score isn't excellent. Consumer Reports magazine found that the typical Louisiana driver with a good record and good credit, just good, not excellent, pays $315 more simply because they only have good credit and not excellent on average. If you have poor credit but a good driver, you'll pay on average $1,650 more. And in fact, Consumer Reports magazine found that in Louisiana, somebody who has a perfect driving record but poor credit will pay $905 on average more than somebody with excellent credit but a conviction for driving under the influence. It costs more to have poor credit than to have a DUI conviction on average in Louisiana. And I've confirmed that with tests of my own with at least one company here in Louisiana, with credit score having an impact of 133% on your rate. So each of these items I've described here contributes to the piling on that I mentioned earlier that happens to low and moderate income drivers in Louisiana whose driving skills might be impeccable, but whose economic status and personal characteristics are held against them by insurance companies. The effect of that is, for one, a lot of people are complaining to you about very high premiums, but what they don't realize is that they've been targeted with high rates due to non-driving related factors. Another effect that's very important, I think, for you to consider as you think about how to reduce premiums is that you have a lot of drivers who are now uninsured. That's something, Senator Gotti, you also mentioned, who are uninsured because of this mismatch between the premium and their ability to pay, and the mismatch, of course, occurs because all of these things are proxies for their income. So you want your insurance premiums to send signals to customers that if they reduce risky behavior, then they're going to get a benefit of lower premiums. But what signal does the current premium pricing system send? Get a better job, go back to school, fix your credit, don't let your spouse die. Those don't help people become better drivers. And that leads to a broader impact on all Louisianans. Namely, you have hundreds of thousands of safe drivers who are kept out of the insurance pool. because premiums are just too high for them to afford insurance. So in health insurance, I'm getting close to wrapping up here, but I just want to highlight this thing. In the health insurance market, I think many of you may have heard the term young invincibles. These are the young, healthy people that we really need to get into the health insurance pool to spread the risk because they're healthy. They'll pay premiums, but they don't get sick. They don't file claims. In the auto insurance setting, safe drivers, they're your young invincibles. So when you allow insurance companies to throw up these kind of barriers to safe drivers accessing the market, you're keeping good drivers out of the insurance pool. It means the pool is narrower, and it means more people have to shoulder more of the costs. When you expand the pool by bringing these drivers into the market, these good, safe drivers who there but for fortune, go you or I, if you bring them into the market, then we expand the pool. We lower rates for everybody. Fewer uninsured motorists is good for everybody, and there's also that incentive for safe driving. So to wrap up, I'd say you can address each of these, and you wouldn't be the first to do it. You wouldn't be blazing any trails. Just recently, Maryland's Republican governor signed a bill ending the widow's penalty in that state. Minnesota doesn't allow auto insurers to charge renters more than homeowners on auto insurance. California, Hawaii, and Massachusetts prohibit the use of credit score. New York regulators recently stopped companies from using education and occupation. Montana, in their rate setting, Montana and 6 other states prohibited the use of gender in auto insurance. You don't have to blaze any trails to protect consumers here, and with that, you could lower rates immediately. So I'll just wrap up my testimony by saying that the research into the non-driving rating factors in Louisiana shows me there are opportunities to create savings, but also you need to ensure that the regulation of these companies and the transparency that is imposed or that is demanded of them allows fuller oversight of this company, because the states where we've seen the best results, and the best example is California, where rates have gone up much more slowly over the past 30 years than in Louisiana. They're the states that have more transparency, more oversight, and they place the burden of justifying rate increases on the companies. They don't just say, well, if the insurance department can find something, then we'll stop them. So I'll leave it with that, but I do think, and I'm happy to answer any questions, I do think there are more opportunities to save money and still have a competitive market in Louisiana.
And we do have a couple of questions for you.
Thanks.
Senator Luno.
Actually, you answered most of my questions I had when you finished up, but God, I wish you'd have been here last week when I got killed in insurance committee on all of these same issues. Maybe we could have shed some light on them, because what I continually heard was, well, we don't know exactly about that, and we don't know about this, and it's a algorithm, and it's this, and it's proprietary information. And what I gleaned from a lot of this was that when you have transparency and you have tighter regulation, that equates typically to lower insurance rates. Is that fair to say?
That's absolutely right. And one of the things that's interesting about this, because I know there was some talk earlier about the importance of competition. So California has much more transparency. We can see the companies have to file everything. There is no trade secret information in California. So we can see it all. And that's how we're able to figure out when rates are going too high. But California also, using the Federal Department of Justice, it's called the HHI, it's an index of market concentration. California is the second most competitive market in the nation. So you can oversee these companies, demand transparency, and maintain competition. And that's an important thing that people assume, well, if you're going to regulate, that harms competition. In fact, we have a problem, a mismatch, because we force people to buy the product.
Yeah.
So you're going to have depressed competition if you don't rein in the companies that are charging people that price. So that's why it's actually, we enhance competition with better oversight of these companies.
All right, sir. Thank you very much.
Thank you.
All right, Senator Martini.
Just one question. What rationale can these companies give for a widow's penalty? I mean, did they study this, or they just grab this out of the air and figure that's a new way to charge people?
Well, I'd let the insurance
You're talking about, what was the girl's name? Roberta or whatever.
Oh, Roberta, yeah.
Whatever. I mean, it just seemed that the things that they were bumping her up on were just arbitrary things that they just kind of grabbed at.
Well, I've been looking at insurance rating practices for over 20 years, and I've been asking that question of companies. And I'll let them speak for themselves. Usually what I see around the country is they'll come up and they'll say, the data show or the algorithms demonstrate that
show that if your spouse dies, you're more of a risk. Is that?
Well, I'll be honest. I involved in a rate challenge in California where a company was doing that, and I looked at their data, And they were imposing that. And I said, if you actually look at the data, it doesn't show any actuarial indication that the widows should be paying more. And the company very quietly refiled their data without this widow's penalty because they were caught, because we could see them. I mean, the thing is, with these insurance companies, you have a law in Louisiana that says rates can't be inadequate, excessive, or unfairly discriminatory. But then it bars off the excessive part, and it says, if we find that the market is competitive in Louisiana, then there's no such thing as an excessive rate. So the problem is you've kind of tied your own hands, and you say, as long as the insurance commissioner says the market is competitive, there's no such thing as excessive auto insurance rates. Now, I know you had testimony here earlier today that this market isn't competitive, but if you read the annual reports of the property casualty of the Department of Insurance, it says the auto insurance market is challenging but competitive. And that's in there for a reason, to prevent these kinds of practices.
Thank you.